Welcome to Volatility 411 for equity, armor, investments. I'm Joe Tigay. Let's jump right into it. We got a settlement today in January. The VIX futures and options settling in at 22.79. Right now, the VIX cash is at 22.50. Real quickly, looking at the VIX futures curve, that Fab futures at 23.30. That's a small difference between where the future and the cash is this early in the cycle. Oftentimes, when I see that narrow difference, I tend to see higher than usual volatility in the futures. That said, we're just at the start of the cycle, so that is countering that effect. Usually there's lower volatility right when the month starts. Now, February, I want to remind everybody also is a volatile month for the market and also VIX futures, so we're watching all that as it plays out. The market, for its part today, the S&P 500 is up small, up 8 handles. The Nasdaq's kind of leading the way. And the Nasdaq overnight traded down very close to its 200-day moving average and has since recovered. And this year, I just want to go back and just look at the market in equities and bonds. They are trading very highly correlated. It's been the case for some time, but specifically this year, almost on a one-to-one basis, we're seeing bonds moving the same way as equities. And they're both keyed in on what the Fed's going to do. The Fed's been talking about inflation. The Fed's been talking about raising interest rates. They've been talking about reducing their bond purchases. And with that in mind, I went back and looked at the last 4 times the Fed raised rates going back to 1994. They started the rate rising cycle. The month after that rate hike, we saw the market down 4% and the VIX up 28% on average. So that's kind of surprising. All those times the market was ready for all those moves, and that still is what we saw over a 1-month basis. Now, keep in mind though, when the Fed does start to raise rates, that usually means there's a strong economy. So if you look at 6 months later, we actually see the market almost up 4%, 3.8% in the S&P 500 for 6 months, even after that disastrous first month start. And we also see the volatility is down over that period, even though VIX is up for that first month. So that's what I want to keep in mind. History does not repeat itself. It might rhyme sometimes. So if we do have a strong economy, we might be in store for a good 6 months. Now, that said, the last 4 times we raised rates, we didn't have inflation as high as we have now, and we didn't have PE ratios as high as we have now. So watching the 210 spread is going to be key for me. If that can maintain its level or go higher, I think the economy is strong. If it starts to come in, that's telling me the economy is weak, and people are expecting, even though rates are going up now, they're going to be going down in the near future. For Equity Armor Investments, I'm Joe Tigay.